Okay, let's take a look at Chapter 4 where we'll deal with job costing. First, let's talk a little bit about basic costing terminology. Now, there's several key points from either prior courses or prior chapters. First, there's the cost object or cost objects. Keep in mind that they typically are products, but they could be a responsibility center, which sometimes goes as the name of department, though sometimes there's a difference between a responsibility center and a department. Sometimes there are many responsibility centers that make up one department. All depends on the particular business. Sometimes a cost object can be a customer, a product. Product is typical. Sometimes it can even be a channel. Okay, direct costs and tracing. Usually materials and labor are considered direct cost, and usually just direct materials and direct labor, but there's some exceptions to that as well. And any indirect costs and costs that are allocated are usually considered to be overhead. Okay, a cost pool is any logical grouping of related cost objects. Okay, and a cost allocation base is a cost driver used as a basis upon which to build a systematic method of distributing indirect costs. So, for example, in the example we see on the screen is direct labor hours can cause indirect costs to change. Therefore, direct labor hours can be used to allocate costs among objects based on their usage of that cost driver. In this case, the cost driver is the direct labor hours. Okay, when we talk about costing systems, job costing is one that ends on one side of the spectrum. Process costing is on the other. Job costing is a system accounting for distinct cost objects that we refer to as jobs. Each job may be different from the next, and it will consume different resources. Okay, so if you were in a business that made wedding announcements, you might use job costing because every wedding announcement job could be different from another. We may typically find job costing used when we build an aircraft, which is considered many times to be just a large singular manufacturing process. It's a singular event, and we will capture costs by aircraft, in that case by job. Not always, but that's one way. An advertising agency will create jobs for the various ads they run, and they will track the cost of each job. Okay, at the other end of the spectrum we have process costing, and there we're more involved with coming up with the cost of mass-produced identical or similar produced items. So oil refining, orange juice, soda pop, all of those think about in terms of gallons or barrels, and they don't always have to be liquid form. Process costing is also used in the automotive industry, anywhere where we're making mass-produced items that are very similar in nature. In my own background, I was the cost accountant for Penn Racket Sports, where we made 12,500 dozen tennis balls every day we worked. Okay, we used process costing because all the tennis balls were virtually identical. All right, let's talk a little bit about costing approaches. Actual costing will allocate indirect cost based on the actual indirect cost rates times the actual activity consumption. So the idea here is we're not using any predetermined rates. We're waiting till we know the costs, and then we allocate the actual cost based on actual activities that were consumed. Okay, normal costings is a little bit different. We allocate indirect cost based on a budgeted or predetermined or forecast. All of those terms can be used interchangeably. Indirect cost rate times the actual activity consumed. Okay, now both methods allocate direct cost to a cost object the same way. and they're based on actual costs. So actual direct costs are used, but with normal costing, we use a budgeted cost rate times the actual cost, actual activity being consumed. All right, now let's talk a little bit about the 7-step approach to job costing. First, we identify the job to be costed. Then we identify the direct cost of the job. Next, we select the cost allocation base or bases to use to allocate indirect cost to the job. And fourth, we match the indirect cost to their respective cost allocation base. Now, that's the first 4. All right, the 5th step is calculate an overhead allocation rate. And we do this by taking actual overhead costs and we divide it by the actual overhead allocation base. In the previous example, the base was direct labor hours, but there certainly can be others, machine hours, and there may even be more than one base. It's step 6, we allocate the overhead cost to the job. We do that by taking the overhead allocation rate times the actual base activity for the job. Then, step 7, we compute the total job cost by adding all of the direct and indirect costs together. Okay, a little bit of a job costing overview. Blue off to the right is the cost object. We're calling it job number 123. And we specifically identify $100 of direct materials for that job. We have some kind of systems in place so that we apply the materials or we order them and jot down the job costing number. The degree of sophistication used in job costing can vary by business and by industry. We do the same thing with direct labor. Somehow we track who's working on which jobs, and we specifically identify the direct labor amount that relates to job 123. And job 123 could be a particular wedding planning event. It could be a custom axle system that was being made, a custom motorcycle, an airplane, anywhere where we're using job costing. Even in a law firm, we could be tracking materials if there are any. In this case, they'd be indirect materials, but we could be tracking labor hours using a job costing system. Then, when we get to the indirect cost, that's where it gets a little bit more sophisticated. We first assemble the indirect cost pool. We grab all the manufacturing costs. We figure out what the base is, in this case direct manufacturing labor hours, and we come up with an overhead allocation rate. We take the cost divided by the base, and then we apply it times the job. So in this case, if there was 5 hours used in job 123, and we figured that there's a $10 cost per labor hour and we're applying it based on manufacturing labor hours, then we multiply that $10 direct labor hour cost times the 5 hours and apply $50 to job 123. Okay, now with regard to journal entries that go into job costing, we make them at each step of the production process. So in other words, anywhere we can identify costs that relate to the job and we can identify them at that point, then we go ahead and we make that entry. The purpose is to have the accounting system closely reflect the actual state of the business, its inventories, and its production process anywhere where at any point where we would assemble financial statements. Okay, now product costs are accumulated in a work in process control account. We typically see 3 categories: direct materials, direct labor, and factory overhead applied. Sometimes it's called factory overhead allocated. Sometimes it's called factory burden. And it would be burden allocated or applied. But in a job costing system, the amount of indirect costs that get allocated to the jobs always has the word allocated or applied with it. Okay, now actual indirect costs are accumulated in a manufacturing overhead control account. And actually in practice, there's many manufacturing overhead control accounts. We may have one for supplies, one for indirect labor, one for indirect outside services. There can be many, but we group all of those accounts and usually rely on a numbering system within the general ledger to know which ones are considered manufacturing overhead control. Okay, when we purchase materials on credit, we would debit materials control and credit accounts payable control. Now, specifically in the job, we may identify what job it's for. If we know that, there's a good chance we will recognize that right up front. Okay, and if we requisition direct, indirect, and indirect materials, okay, and indirect materials are overhead into production, then what we would do is debit work in process control. That shows the materials going into production. We would debit manufacturing overhead control. That's showing us that we're now moving indirect materials from a supplies category, if you will, and materials control is essentially a supplies category or a raw materials category, and we're moving it into production. Okay, now that Z should be I wonder if I move my mouse, I don't know if you can see it. The Z should be appear right over here, so indented just like a credit would be. But on this journal entry, on this slide, it came off a little bit off-centered. Okay, when we incur direct and indirect labor, we would debit work in process control, debit manufacturing overhead control. Now that's for the indirect labor, and then we would credit wages payable, and wages payable would reflect both the direct labor portion as well as the indirect labor portion. Now, when we incur a variety of actual expenses, we're going to debit manufacturing overhead control and credit salaries. So that would be for, let's say, an indirect worker that's working on the job, say a supervisor. We may credit accounts payable if we're buying indirect supplies or using outside services. All the indirect costs get accumulated into manufacturing overhead control. Now keep in mind that we may, in a subsystem, be identifying what jobs those are for at the point where an indirect worker writes down what the cost is for, or we may even make it on a requisition form when we go to purchase it from an outside vendor. Okay, we also have a credit to accumulated depreciation for equipment depreciation relating to factory equipment. That also is going to be debited in manufacturing overhead control. And if there was any prepaid expenses that we were using that go into manufacturing overhead control, we'd credit that too. So a typical example would be general insurance on the manufacturing assets, where if we paid for that up front, each month we may be debiting manufacturing overhead control for 1/12 of the annual cost and crediting the prepaid insurance account. Okay, when we allocate the application of indirect costs to the work in process account, we do it based on the predetermined overhead rate. So we would debit work in process control and credit manufacturing overhead allocated. Okay, or applied, allocated or applied, used interchangeably. So with job order costing, we're always using that rate-based approach to get the overhead to the jobs. Okay, the actual overhead costs are never posted directly to work in process, or if they are, we have to adjust for them at the end of the month so that we only are applying into work in process manufacturing overhead that's been allocated based on some rate, whether it was actual or predetermined. Products that are completed and transferred out of production in preparation for being sold, the entry is very simple, and you see it here. We debit finished goods and we credit work in process. Okay, and then when we sell it to customers, you've seen these entries before. we debit accounts receivable. This slide calls it accounts receivable control, and the whole idea is that we've got a subsidiary ledger for every account we sell it to, right? So it really would be accounts receivable dash XYZ company if we sold it to XYZ, and we credit sales. But then we also record the cost of sales at the same time by debiting cost of goods sold and crediting finished goods or finished goods control. Okay? If we have a difference between the sales and the cost of goods sold, that's called gross margin. Not if, we would expect to see a difference and we'd expect it to be positive. Okay, now with overhead, remember that we use two different overhead accounts in the journal entries we just saw. Manufacturing overhead control was debited for the actual costs, and overhead allocated is credited for the estimated or budgeted or predetermined overhead applied to the production through the work in process account. So if you got lost on that, I'd say go back and look at the entries again, or take a look at it in the textbook. Okay, now actual cost will almost never equal budgeted cost, so we wind up with an imbalance. If the overhead control, think of that as the actual spending of overhead, is greater than the overhead allocated, then we've under-allocated the overhead. If the overhead control, again think of that as the actual spending we spent on overhead, is less than the overhead allocated, then that's called over-allocated overhead. And we need to figure out how to account for the difference. And it's eliminated in the end of period adjusting entries using one of three methods. And normally, whatever method is used, it's used based on materiality, consistency, and practice within the industry. Okay. One is called the adjusted allocation rate approach. So we figure out what the difference is for over and under applied overhead, and then we recalculate it based on actual exact overhead allocation rate. Okay, that's takes some amount of work, but it's one method that's used. The proration approach is where we take the difference in what was allocated between. We take the difference of the over and under applied situation, the over and under applied overhead, and then we allocate that difference between cost of goods sold, work in process, and finished goods based on the relative amount of their sizes. Okay, and then the most common way is to write off the entire difference to cost of goods sold. And if the company has a small amount of inventory on hand at the beginning and the end of the year, that usually is fairly accurate, because most of that difference had already been sold and flowed to cost of goods sold anyway. But that's the most common approach.